Very good. Well, good morning, everybody. And let's talk about cotton first off. We are still what I would describe as range bound, but we're in a somewhat higher range if you look at the far right side of those blue ups and downs. I'd say from about a little before August and the entire month of August, we've been bouncing at a higher range between 85 and 90. We're still bouncing off the upper 80s, and then we had that hurricane. This last little peak up to 90 cents was the market response to, I forget the name of it, Idalia. Did what normally happens, a hurricane hits mature cotton over in the southeast and scares everybody. But those things usually don't result in the destruction of a lot of cotton. They usually result in the degrading of a bunch of cotton, just rain, which means that the cash market will be sorting out, you know, color stained cotton, otherwise degraded cotton. That's a cash market thing. It doesn't really destroy thousands or hundreds of thousands of bales that affects the futures market supply and demand balance. It's really just a quality deal. That's what usually happens with these late season hurricanes. That's apparently what happened with this one because the market bounced off 90 cents. A bunch of growers were selling up here, and that contributed to the selling pressure. And so we're still bouncing around in this range, and we're beginning. There's still some time left for a rally, but as things are unfolding, the point of my remarks is we're slowly getting the picture of how much production is there, and as that becomes more certain, the chances of a surprise weather market rally are they're kind of fading from where we are now going forward. So let's kind of sum that up. What I've got here, the third column here is USDA's current balance sheet for U.S. cotton as of the September supply and demand report. And what they did, the changes that they made from the previous report, or I've scribbled over here in red, they tightened things up, basically. They lowered planted acres, which lowered harvested acres. They kept the abandonment percentage pretty much the same at 22%. So this would be tightening up the picture: fewer planted acres, fewer harvested acres, a smaller supply. But just to kind of offset it a bit, they raised average yield per acre somewhat. From, it was 779 pounds, they raised it to 786. So not quite making up this loss of planted acres, but offsetting it slightly. And this really isn't surprising that they would raise yield, because what they probably assumed was they were taking out low yield, low productive dry land, and that raises the national average as a result of doing that. So fewer acres, a little bit higher yield, but it results in an 860,000 bale cut in the estimated production. That's down from 14 million. Okay, so that would tighten up the picture, except for one more offsetting thing. And as is typically the case, when they lower production, they usually cut exports, which is down here. They cut exports 200,000 bales. And again, that's not surprising. We got fewer bales to export, fewer exportable supplies, then they'll cut the export forecast. It's also true that Brazil is having a huge crop and is selling a lot of their cotton at discount prices, and that competition would probably also justify lowering our target for exports. So again, tightening things up, but offset a bit. And so the bottom line of it all, even with an 860,000 bale cut in production, the net effect is a 100,000 bale tightening of ending stocks. It went from 3.1 million to 3, which is perhaps a little bit disappointing for some. A lot of people have been, especially out in West Texas, a lot of people been expecting a cut in production, and they're expecting that to go to the bottom line and tighten things up in a big way and raise prices. But you have all these offsetting effects. So yeah, a modest tightening of ending stocks, a modest tightening of the bottom line, which should support prices, but it's just not a huge adjustment when it's all said and done. And the market didn't react hugely. Like I say, we're still just kind of trading in here at 87 something. And as I started off saying, I think time is running out for big surprises to happen, even if they cut production more, which they're gonna do. Because think about it, there's a lot of low yielding crop, especially dryland in the rolling plains and other places, that it got planted this year, and it came up because of the moisture in May. And there's a standing crop there with probably not very many bulls on it. So what's going to happen to it? Well, the crop insurance adjusters are going to pay it a visit, and they're going to make a decision whether there's enough yield out there to harvest or not. And I think a whole bunch of that kind of acreage, it's going to get zeroed out, and it won't get harvested. And so that means the abandonment's probably going to be higher. The harvest acres is probably going to be lower, and this production number is probably going to drop. But I don't think that's a huge surprise to anybody. So, and even if they do cut this production number, they'll cut exports again to partially offset it. So, I think we're getting closer and closer to the bottom line, what the real ending stocks forecast is going to be. I think we're within probably 200,000 bales of it. It may stay right here at 3, or it may be 2.9 million or 2.8 million. But I guess the story I'm trying to tell is I don't think there's a big surprise that's going to give us a big rally going forward. That's, anything can happen, but I think the possibility is fading, the way I said that. So now we've got more information coming that'll help us refine, us being USDA mainly. They're working off this planted acres number from June, but they're updating that with certified acres data. That kind of data trickles in all fall. They also get data from the Risk Management Agency about acres that are zeroed out, so that'll figure into the total picture. They survey gins about how many bales have been ginned, and they count bales, how many bales have been classed. And so these two begin to dominate the reasoning in how much is actually out there. This classing number is probably the best number that's there. Now that's an unfolding number. This number, sometime in about March or April, the bales classed will actually be the estimate of production. They'll reconcile all these things to the classing. And I actually wrote an article in Southern Ag Today, and it's in today's article on this link right here, about this issue and how they reconcile classings with ginnings with production, if you're interested in that. And if you're not a reader of Southern Ag Today, I would point you in that direction, and I'll put this link in the chat. And this is just kind of the last thing showing. These dots are showing the percent deviations of USDA's guesstimate in August, September, October, November. The deviations from the final actual true number. And what this is showing you is just they zero in on the estimate, and it takes them all fall to zero in on the estimate of what the production is. But when they get to about January, half of them have reached the final number by January. And when they get to March and April, in most years, they've reached the final number. So they're going to be zeroing in on it based on all this data inflow. And as they do, the premium in the market, the uncertainty premium is just fading as this tightens up. So that's all I've got. I'll get off, but I'll be here for the rest of the presentation, and I'd be happy to entertain any questions.
Great. Any questions for John? You can always put them in the chat too as we go along. So John's going to try to quit sharing his screen.
Oh, yeah, I am. I'm gonna try real hard there.
And while Mark's talking, I'm going to try to see if I can remember how to share my screen. So,
Mark, I'm working on it here. Let's see how successful we are.
That looks good on the first try.
Is that right?
Yeah, just hit show mode.
And I am not seeing it. Oh, here we go. I lost it on my screen. So let's go to the slideshow from the beginning. Did we get there?
Yes, sir.
All right. Well, great to be with y'all today. I'm going to focus my comments on the corn market. If you have questions regarding maybe some things that might be related to sorghum and its relationship to corn, or things that are unfolding in the wheat market, we'd be glad to touch on those if you have any questions related to that. And you're going to see this information presented in much the same way that Dr. Robinson just did on the cotton. And what I've got up here now is the balance sheet from the World Agricultural Supply and Demand estimates that come out every month from USDA and the Outlook Board. And what I'm showing are that in corn for U.S. corn, last year's corn crop, the 22 corn crop, versus the latest update for 2023. So this is not the monthly change. This incorporates what we look at right now for this year's corn crop relative to last year. And a couple of points off of that, if you look, the biggest change this year is the planted acreage. We're last year, 88.6 million acres of corn. This year, almost 95 million. From August to September, USDA raised that planted and harvested number 800,000 acres. So we had a surprising increase in acres last week in the WASDE report. And that's really offsetting what we're seeing kind of on the yield. The yield estimate's about where we were a year ago. They started out the year at 181 bushels, 177 in July, 175 in August. USDA dropped that to 173.8 in the September WASDE. And we'll look at those crop condition ratings and maybe some explanation of that yield estimate here in just a minute. But that's really the big story this year is the no big bump in yield, but we're making up the difference in acreage. If you look at that production number, that 15.134 billion bushels of production, that would be the second largest corn crop in U.S. history. A few years ago, we had just above that number, but we're right in the top range of production here in the U.S. for this corn crop. And we are seeing some increases in use relative to a year ago. Primarily, the USDA is more optimistic in the export picture for this 23 corn crop than we were last year when exports were relatively disappointing. More competition out of South America. We've got the strong value of the dollar that's working against us. And so we're struggling in the export picture from a year ago, and USDA expecting some increase in that for the coming year. The total use number, though, really very little different from that 22 crop, and some increase than the significant increase than in ending stocks relative to a year ago. And these changes, by the way, there's a percentage changes. So the big number that's really affecting our price outlook is this stocks to use ratio, this carryover in days of use on hand at the end of the marketing year. How long can we live next year on the crop that was left over last year? And we're coming from a 38, 39 day supply in last year's corn crop, projecting all the way out to a 56 day supply. And that's a relatively large pile of grain. And we'll put that in perspective here in just a minute. But what's concerning me overall about our grain markets and the outlook for prices for this 23 crop and perhaps even beyond is that with the significant increase in prices that we've had really the last 2 or 3 years, we've been on an upward trend in grain prices, providing incentives to increase production as weather will allow. Combine that with some moderate growth in use, but our use increases are limited or meeting headwinds from economic increases, economic activity just the influence of of slower economic conditions that create a more difficult environment to increase use when we're operating in a price environment where all the incentives are to increase supply. And I think this spreadsheet right here, this balance sheet, gives an excellent example of that, where in the corn market for corn, we're looking at almost a 10% increase in supply relative to a 5% increase in use. And I can take that same example and I can apply it to sorghum, I can apply it to wheat, and not quite so much as much in soybeans, but even applies there. That the incentives there are for production increases or supply increases greater than that, particularly in the current economic environment, for increases on the demand side. And so that's where my lower price expectations will continue for this fall and are carrying over into the 24 crop that we'll talk about here a little bit as well. These are the crop condition ratings for U.S. corn that we've been getting since late May. That blue dotted line would be what the average condition rating ought to look like. This is an index that's created from these different ratings that we get every week. And you can see that even though we started right at normal back in May, this year's conditions ratings have struggled to get close to normal. And then we faded again here as we've gone toward the latter part of the growing season. Now let's zoom in on that just a little bit, get a little closer look at those ratings. Here again, this is your average condition rating through the year. And had we achieved these kind of condition ratings, we would be looking perhaps at a U.S. corn yield of that 180 or 181 bushels. We ought to be looking at something close to trend line with average condition ratings. The green line are the condition ratings for 2023, compared then in the black line to 2022. And so again, you can see we fell off pretty hard at the beginning of the year, kind of bounced back, and we're coming in late season now with ratings that look somewhat like they were a year ago at this time, when our yield was 173 bushels, which at that time was about 3% below the trend line projection. The estimate, again, from September, that 173.8, that's about 4% below that trend line estimate of 180, 181 bushels. Again, certainly trimming the yield expectations for this crop. Have we got more we could take off? It's hard to gauge until the combines start running. With the heat that we've had across much of the Corn Belt this year, how is that going to affect the grain fill and the kernel weight as we wrap up the season? You know, there are many parts, particularly in the Eastern Corn Belt, looking at record yields this year. If you look at parts of Iowa, they've struggled much more as we finish up the season. So we still in a few weeks we're going to have a much better picture on this U.S. corn yield. But I certainly cannot argue at this point with USDA's estimate of that 173 along in that ballpark. I think that seems very reasonable given the information we've been able to gather at this time. So raising that days of use on hand back from that balance sheet, going from a 38-day supply all the way out here to a 56-day supply. You can see what the impact would be, the price response of that kind of movement in the relationship between that days of use on hand estimate and the season average farm price. That's kind of exactly the price impact that you would expect to see the price paid to the farmer for this marketing year averaging about $4.90 a bushel. That makes a lot of sense, given that significant increase in that days of use on hand. If we were to trim that yield somewhat, maybe tighten up that supply a little bit, yeah, there would be a positive price response, but I think it would be very moderate, unless it was a big shock of some sort. But if we were even to reduce that yield, say to 171, 172, yeah, that would tighten up that supply a little bit. But we're over here in this range now that it looks like a much above average kind of carryover. And this is kind of the biofuel era, 2005 through this 23 crop. And you can see the degree that pushed that stocks to use ratio way to the right. And that's why it's putting such pressure on our prices. So what about 2024? I think, you know, settling in on kind of where these prices and production estimates are for 2023, I'm not expecting any big surprises as we wrap this thing up. Are there signals or implications that we might look to for the 24 crop as we look at grain production and prices and supplies? One thing of significance that looks a lot different as we head into 2024 than 2023 is the price of fertilizer. This chart tracks the price of anhydrous ammonia in the black line, the price of natural gas, and then in red, and then the price of corn in green. And these are national average cash corn prices, except for one. Those we kind of get a lag in the delay of our information from NAS. And so what I've stuck in the chart for the latest number for the price of corn, this is the cash price paid this fall in central Illinois. And that cash price is about $4.50 a bushel. And looking at that cash price following, natural gas has been cheaper, much cheaper than we thought it would be this year, especially given the conflict in Russia and Ukraine, and then the significant fall in the price of anhydrous ammonia. Looking at back down to around $600 a ton when we were up that $1,415 to $1,600 a ton about a year and a half ago. So certainly a much better price outlook for some of our input costs, particularly when it comes to a high nitrogen using crop like corn. But the price of nitrogen is lower, but also the price of corn. So what about in the relationship of one to the other? And this reflects the price of anhydrous ammonia in terms of how many bushels of corn does it take to buy a ton of anhydrous. And the average, if you go up this 4-year average back from October of 2017 to October of 2021, the average price of anhydrous in terms of the bushels of corn it took to buy that ton was about 142 bushels of corn. You can see with the record high fertilizer prices that went well above 250. And with that, those current numbers that we've just plugged in there from that previous chart, right now heading into the 24 crop, we're at 131 bushels per ton. So certainly right back into this long-term range of relatively stable prices, which looks much more positive for our input cost side of corn going into 2024. But there's some other factors I think to be aware of too. And one thing I want to touch on very quickly is this blue line. If we look at the demand for corn, I want to look at some aspects of fuel. Dr. Anderson is going to share with us in just a minute some livestock numbers that might give us some expectations around what we could expect on feed use. So I want to, and feed and fuel, obviously the two highest use categories for U.S. corn. I want to look at some components that impact where might we be headed on that fuel use category. And we've got some concerns there. These are projections of gasoline demand and ethanol consumption from the Energy Information Administration. And these are projections for the current, and I've got this by corn marketing year for gasoline demand and ethanol demand, and then for the projection for this 23 crop. And you can see that for gasoline and for ethanol, even though we're up a little bit closing out this 22-23 marketing year, we're not back up to pre-COVID levels in terms of gasoline consumption in this country. And then with, of course, increasing energy efficiency of automobiles and the increasing number of vehicles on the road that don't use any gasoline at all, with electric vehicles gaining some favor and from policy-wise, as perhaps from consumers as well, we may have reached peak gasoline consumption in this country. And so that certainly is a challenge for the ethanol industry in that we run about whatever gasoline consumption number is, about 10% of that is ethanol. And those projections are consistent with what EIA is projecting as we go out into this 23 marketing year. That's the ethanol side. And if you take those same numbers, this is again from the EIA, they report this energy consumption, these renewable energy components for consumption in terms of British thermal units or BTUs. And again, if we look at the growth in the ethanol consumption by BTUs, you can see we're kind of flat here in 21 and 22, and then some slight decrease as we head into 23 and 24. Not a lot of growth on the ethanol side of the renewable energy consumption question. The difference or contrast that then to biodiesel and renewable diesel. A lot of interest, a lot of investment in increasing the production and the consumption of diesel from biodiesel and renewable sources. So I think that puts us, if we're looking at a demand growth for our grain markets, it's much more so in the fuel oil category on the diesel component rather than growth in ethanol. And I think that's starting to, you can see that a little bit in the separation of prices for corn and soybeans. These are the November 24 soybean contract relative to the December 24 corn contract. For much of the year, those traded just right one in lockstep with the other. Corn and soybeans right along together. As we've gotten into this fall, there's been some degree of separation of that November contract for soybeans relative to corn. That price relationship, that price ratio is painting a more favorable picture for planting soybeans in 24 relative to planting corn. Now, again, we got lower fertilizer prices, so that may help us on the corn side. But if we're looking at market signals, it may be pointing us toward that shift in acres where we dropped soybean acres this last year and increased corn. I think we're shaking up to a flip in that situation for 2024, which is a more bullish outlook for corn prices. In that if we were to see a lower corn plantings next year and then see those acres going back to beans. So again, I think that's just shaping us up for what may be some indicators for this for 2024. What I brought to share. Appreciate your time here today. And if you have any questions, be glad to try to hit some of those. But again, thanks for making this opportunity possible.
Hey, great. Anybody got any questions for Mark? I thought I saw something in the chat, but maybe not.
No, the chat stuff's from me.
No, that's good.
Good. All right, no questions. Shoot, I'll jump into mine. Let's see if I can make this work. Thanks, Mark.
Right. So when I get a tax return from him.
Hey, I might say too, whoever, we might need to hit your mute button. Hey, Mark or John, does that look all right?
Yep, looks good, David. Think we're ready to go.
Oh, great. It's a miracle. When I was putting this together, I kind of pulled, I think I got about 7 points here of stuff that is, I think, in the news or is going to be in the news in livestock markets. And as Mark said, one of the reasons for decreased, I might argue for decreased feed use, we certainly have fewer cattle on feed. Pork production this year is almost the same as it was a year ago, but we got more sows going to slaughter, and it looks like production in the coming year is going to be declining because hog farmers have been losing money, and so less use there. It would appear to be some reduced chicken production as well, and so if we think about those big three meats, I think there's some argument there for some reduced feed use going forward, which, in a feeding situation, largely corn. So I think that's part of this declining use on the corn side. It's just going to be coming from the livestock side. So let's see here. My first, there we go. I got my first request for a media interview yesterday. I was sitting at my computer last night, kind of getting ready for today, and it popped up from a guy at one of our local newspapers asking. He said, "Hey, is it too early to ask you anything about turkey?" And I said, "No." I said, "I think this is pretty timely, given where we are. We're really only 2 months out from it anyway." So what I thought I'd do is I'll just start with turkey prices because this has certainly been a hot topic over the last couple of years. And I think the keys here really are, if we look at these are whole birds, these are hens. So hens are smaller than the bigger toms. But We've got prices well below a year ago, and sort of heading down. And it's really turning on increased production. We've got turkey production about 5% greater than a year ago. Remember, a year ago we were hit with avian influenza that sharply reduced the number of birds. We saw prices really skyrocket in the wholesale market. This is a wholesale market price. We don't really get very much retail average prices. There is a USDA Ag Marketing Service report on retail featuring. In this time of the year, there's very little featuring. There are very little prices reported or sale prices just because of the time of the year it is. But the key is we're producing more turkey. We haven't had avian influenza. High prices spurred profits, and as long as you had turkeys to sell, spurred some profits, some increased production. So far this year, we have produced almost the same amount of turkey as 2 years ago. So really, it's we got the same amount as 2 years ago, certainly more than last year. We've got more turkey in cold storage, preparing for Thanksgiving, and so it's really leading to some lower prices. So, I think that's kind of in a nutshell what's going on with turkey prices. Again, it's wholesale, but many times at our grocery store, what we're seeing for a price really relates to a special or a feature or tied to a basket of stuff. You may buy everything else you're going to buy for Thanksgiving and get a deal on the turkey. So, retail prices are a little different because they are such a big holiday item and often a sale item at your grocery store. But this really, I think it gives some room for grocery stores to do some more featuring perhaps for Thanksgiving, and we might really see some better deals. And so, this may help you out in terms of you get some kind of questions about turkey prices. That's what's going on. Another thing I've seen in the news a lot is in the last couple of weeks particularly is more on imported beef. Are we getting more imports? Well, we've got record high retail prices. We've certainly got high wholesale prices, and high prices are really a market signal. We got two things happening. High prices are a market signal that we become a more attractive destination for imports, particularly for lean trimmings to turn into ground beef as we have fewer cows going to slaughter. So what we're seeing is really what we ought to expect in this really higher price environment is that our imports go up and our exports go down. So what I've done is I've shown this with net imports. So it's imports minus exports. So last month, July is the last data we have. We had about 80 million pounds where imports exceeded exports by about 80 million pounds. That's really, I think, the trend we're going to be talking about over the next couple of years is relatively more imports, relatively less exports. And it's really a market price driven phenomenon. Our prices are high. This is the direction we ought to expect. 80 million pounds is another, about a quarter of a pound per person if we thought about per capita consumption and relating it to that. We're a little higher than the 5-year average. You notice here in the summer, June, July, we tend to see our largest amount of imports exceeding exports to the tune of about 40 million pounds. So I think in a nutshell, that's really, we're seeing what we ought to see in market conditions like this. We got a cattle on feed report that's going to come out on Friday afternoon at 2 o'clock. I do pre-report estimates for a number of media outlets. I've got placements down. Let me grab my notes here. I got placements down about 6.5% lower than a year ago, which gets us to about 1.97 million. Not too far, just a little below that 5-year average, and certainly down below a year ago is where I have placements in the report. I'll be curious. I'm looking forward to this report. just because, I want to see what those placements are. Are our placements in Texas higher because of the hot, dry weather we had? Have we forced some more placements in Texas, and do we see some different placement patterns in other parts of the country? Particularly an indication, are we holding on to more heifers, driving total placements down? We'll get a better notion of number of heifers on feed in next month's report. That'll have the quarterly estimates. But again, placements below a year ago, and it also gives us cattle on feed below a year ago. Almost exactly, my pre-report estimate would be almost exactly on this 5-year average, down 2.6% from a year ago. So again, fewer cattle on feed, and certainly, tighter numbers, tighter supplies, supporting prices even higher. Let's do a couple of prices. Southern Plains, 500 to 600 pound steers. I didn't get last week's prices in there yet, but generally kind of across the board of some markets I was looking at over the weekend, prices were up about $5 or $6 a hundredweight or so. Some places higher, some places lower. Again, we're getting to the point of the year where normally we would seasonally see our low prices as more calves are weaned and sold. We're sort of bucking that trend a little bit, simply tighter numbers, cheaper feed, and so we're getting some higher prices, kind of, a counter seasonal kind of move to what we would normally expect, but certainly higher prices there. If I look at fed cattle prices, we were up over, gosh, we got to 182, 183 last week. So higher prices there as well, a little bounce back, and we tend to see prices increase in the fall. I think this is sort of the beginning of that. What I might also point out, I think those calf and feeder prices are also being supported by hitting a new record in the futures market for fed cattle prices. You might have noticed that the April contract was $199 and change where we ended on Friday. I haven't looked since the markets opened this morning, but we were almost $2 a pound for April. Well, I think June was $193, so certainly an expectation in the marketplace for much higher prices, combined with some lower feed costs. Gosh, that's going to pull those feeder prices up even more. And I think the real key is, are we going to be able to sustain that on the demand side? If we look at the cutout actually declined a little bit last week. I didn't get that on the slide, but we're sort of in it. If we think about this as a pattern of seasonal prices, we're sort of in this seasonal pattern. We ought to expect some increase as we get towards the fall, a little more into the fall. But again, tighter supplies, supporting wholesale prices, and I think the most interesting there is that consumers seem to continue to be sticking with beef. They continue to buy. I think it'd be an interesting conversation as y'all think about it in your own purchases at your grocery store, and certainly what we've been purchasing as well. Are we continuing to buy as much beef? This is the CPI data, and I went with the choice. That's the one I tend to use. And the reason is, if we look at wholesale prices, we had the box beef cutout get up to $340 and then decline. If we think about lags in the market, we had this choice retail price go up to a new record high of $8.30 a pound. We backed off a little bit from that, just like we saw in the wholesale market. If we looked at the all fresh beef, which is all fresh across all USDA quality grades, it actually hit a new record high in August. And so again, tighter supplies, yet prices continue to suggest that folks are buying beef, that we're continuing to move beef in the marketplace. I think that just with record high prices is a real challenge for us going forward. Because if we think of next year, we got beef production this year that is 5% below a year ago so far. If we're down another 6% next year, which is sort of my working projection, boy, 6% less beef production, higher prices that go along with that. How long do consumers continue to buy at the level they've been buying? I think is the big question for markets going forward. I threw in dressed weights. Through about May, weights were below a year ago. One of the things that while we're certainly sending fewer cattle to slaughter. We've got fewer cattle on feed. Weights are almost exactly what they were a year ago and have been since July, and increasing seasonally. So this is an area that's actually kind of helping production a little bit, that our weights are no less than they were a year ago. So, our reduction in production lately is really all off of fed steer, fed heifer, and cow slaughter declines. And so, weights are hanging in there. That's a question I got last week from somebody, and so I thought I'd stick it in here. 2 cow slaughter charts. Beef cows, almost every week this year, as you know, below a year ago. I think the thing that I'm watching for is that we see a growing gap to a year ago, meaning that we're sending relatively fewer and fewer cows to slaughter this fall, which is certainly part of beginning to expand our cow herd is sending fewer, but also it's true we got fewer to sell anyway because our cow herd is smaller. But that's certainly something I'll be looking for going forward, is that a wider gap to a year ago, a further slowing of cow slaughter compared to what we did a year ago. So I think that's something to watch for in the data. But the other side of that, on the dairy cow slaughter, if you follow milk prices at all, we've had some pretty disastrously low milk prices this year. We certainly had an uptick in dairy cow slaughter. These weeks in July and August, and early, July and August, well above a year ago. Some really large numbers seasonally. I think the real question is, if we culled enough cows nationwide to really support some increased prices with less production. But we may have accomplished that over the last 3 or 4 weeks. We've really seen this back off a little bit, when seasonally we should see slaughter picking up. I think that's a good question for where we're going in coming weeks. I think we may have seen kind of the big surge of culling finished, and then we're going to wait and see a little bit, see what prices do, and can we see some sustained price recovery, which really hasn't happened much yet, but is it enough to spur some more culling? So I think it's sort of a wait and see here on dairy cows, but we've certainly moved more dairy cows to market, in contrast to beef cows. More dairy cows, fewer beef cows. I got this question a couple of weeks ago since our last call about beef in cold storage. Do we have huge burdensome stocks? I think the chart of beef in cold storage would suggest that we do not have large supplies. That's a pretty low number. It's 420 million pounds. We had almost 100 million more pounds than that a year ago. You'll certainly see there is a seasonal pattern to cold storage. This is the time of year we build stocks. I would expect stocks to grow, but well less than that 5-year average. So if somebody's concerned about how much we have sitting in storage, boy, that's not very much, quite honestly. That's, if you think of a population of 330 million people, 420 million pounds is just over 1 pound per person, or 1 pound per capita. So, cold storage stocks, they should be lower because we're producing less. We're still consuming, and there's really not a lot of growth in storage going on. So we don't have a burdensome supply of storage. And one last thing, I want to say something about lamb. I think, while we have less stocks on the beef side, we've actually seen a kind of a growth in stocks here from June to July. Similar to a year ago. It's a better situation in that we don't have the huge stocks we had on this 5-year average. We've got less in storage. That's a positive. Imports have been lower than a year ago. I think that's a positive. But to see those stocks begin to grow now is a little bit concerning, because our production is lower seasonally. But even in the face of that, with some lower production, some less imports, we're actually seeing a little bit of uptick in lamb prices. And so I think that's really sort of positive, but I would point out that we do have stocks a little bit greater than a year ago. So but a heck of a lot better than it has been. So overall, that's likely a positive on balance. That's really my last slide. So I'm gonna see if I can end this show and stop sharing. Heck with that. Anybody got any questions for any of the three of us? Shoot, that's great. Hey, thanks for being with us this month on this. If you get questions, email any of us. Pancho's going to be back, and I'm going to save the recording for him, and he'll get that thing posted to wherever he posts it. And so with that, y'all have a great week, and thanks for participating with us.
Good to be with you. Appreciate it.
We'll see y'all.